Hello, good morning. I'm Avnish Jain. Welcome to the monthly debt outlook from Canara Robeco. As always, let's start by looking at the global markets and global events. Global geopolitics again flared up when Israel attacked Hamas leadership in Iran, and it is likely to get worse before it gets better. However, Iran has indicated that they don't want a full-out war, so somewhat the situation is contained. Coming to global markets, we were seeing the rate cut cycle starting in the big four economies. The European Central Bank had already cut rates some time back. Bank of England also followed by a rate cut of 25 basis points in their key policy rate last week. US Fed is still holding back. In the policy just concluded recently, they have indicated that there's a possibility of rate cut in the upcoming September policy. However, the recent data which just came about 2 days back, the labor data was considerably weaker than expected, which led to a sharp expectation in rate cut dynamics. Rate cut expectations are now expected 50 basis rate cut in September and 50 basis in November. So suddenly from 2 rate cuts, we are now looking at 4 25 basis rate cuts in 2024. This sharp reversal in expectation had led to a considerable rally in bond markets. US 10-year yield, which is the benchmark across the world, fell to around 3.70 from 4.25 in a matter of days. Currently, it's about 3.83 as market awaits further data. Coming to India, while India is somewhat insulated against external pressures, the external linkages continue to put pressure on markets. We have seen, because of happenings in the last few days, the equity markets have taken a dip. Debt markets have benefited out of this mayhem. Our 10-year yield, which was around 695, has now come to around 6.85. Coming to other data points, we have seen inflation upticking a bit to 5.1%. That was on back of higher food prices. Core inflation remains well contained at around 3.1%, but RBI is wary of a rate cut in the immediate future. In terms of growth rate, expectations on GDP growth remains around 6.5 to 7% for FY25, which would be one of the strongest growth in the world. That obviates any need for RBI to cut rates immediately. However, they need to look at global cues as well when they are making monetary policy, which is expected in the next few days. In terms of the budget, after the elections in May of 24, the full year union budget was presented in July of 24 by the finance minister. Surprisingly, government actually brought down the fiscal deficit to 4.9% of the GDP for FY25 against 5.1% earlier envisaged in the interim budget in February 25. So clearly government is very serious about fiscal consolidation, and they are looking at fiscal deficit of 4.5% of GDP for FY26, which was also the glide path for the FRBM target, which government had set for itself about 3 to 4 years back. Clearly, this fiscal consolidation is good for bonds. We have seen bond yields continue to soften over the last 15-20 days. 10-year is now around 6.85. In terms of other flows, obviously, as discussed earlier, the inclusion of the JP Morgan bond index started on 28th of June 24, which has been in the making for last 6 months. Already we have seen FI flows in debt for 2024, that is calendar 2024, at almost $11.5 billion. So that is probably on behalf of the inclusion in the JP Morgan bond index. These flows will continue to support bond markets going forward, even if RBI is not ready to move on the rate cut needle right now. In the policy, we do expect RBI to be more nuanced on the approach on rate movement. While it is expected that no rate cuts are in the offing, there is chance that RBI may move to neutral, especially after what is happening in the global markets where yields have dropped sharply and US dollar also has weakened considerably against major currencies. On the other hand, Japan raised rates first time in almost, I think, 2-3 decades by 25 basis points, which led to some rally in the Japanese yen against the dollar, which may have also contributed to the market coming down, the equity markets coming down in the past few days. For the bond markets, we are positive in the near to medium term. While RBI may be on hold, global rates are coming down and RBI will eventually move on rate cut in the second half of 2025. That is our expectation. From an investor perspective, we believe that the front end of the curve is quite rich and has value. Long end of the curve has already moved lower in tandem with global rates and global cues. The short end of the curve is still not pricing any rate moves from RBI. As and when rate moves happen, the short end of the curve should also move downwards and give returns to investors. In that scenario, investors may choose from medium to short duration funds like corporate bond funds and banking and PSU debt funds. As usual, the investors should look at their risk return profile and also their investment horizons while investing in any of the debt funds. Thank you.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.